The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, on Wednesday, we saw more strength in soybean oil. That spilled into soybeans, while the corn, wheat trade was kind of quiet headed into the 4th of July holiday. We also had another good day in the feeder cattle trade, which spilled over into fat cattle too. Outside market's pretty quiet. We got some things of note, though, that we want to take a look at and examine here as we're looking at Wednesday's market action with no markets on the 4th of July and a hard open Friday morning at 8:30 a.m. Central Time. Let's bring in Mike Zuzolo with Global Commodity Analytics here today for our market analysis. Mike, good to have you back with us here on the program, sir. A happy 4th of July to you and yours. And not as many fireworks as I thought we'd see heading into the 4th of July holiday, Mike.
Well, the week's not over yet, Jesse. And, the Bears have pretty much won the month of June and won the month of most of April. They're really hitting it out of the park here as far as batting average on the short side. I think that's a good place to start today since you and I didn't get to talk since the acreage and stocks report. I kind of feel like I've been zipped back to a time machine to the end of May, where the two big questions are still back on the table, especially for the corn market. How nervous are the funds with their net short position? Now back to mid-April levels at over 277,000 net short futures and options in corn. How nervous are the commercials, or should they be, given the fact that they probably have not gotten a lot of corn bought other than when July went into delivery and producers let go of some old crop because they were forced to. But you've got the top provinces, the top three provinces of Ukraine. And I just looked at this before your show so I could give you fresh information. But you're talking about 40% of the Ukrainian corn belt that has the lowest precip soil moisture profile in 7 years, or right with the second lowest. And so you've got a Black Sea drought still hanging out there. And I wonder how the world commercials feel about this, given the fact that we still don't know what the South American crop is, especially in the corn.
Some interesting points here, and it's a good spot to start talking corn. I mean, it felt like the trade really just said, okay, well, here's the USDA number, and this is what we're going to trade off and forget every other issue out there in the world. I mean, I'll pull up our first chart here on the video feed, and it's, looking at cash and versus corn futures here. There's a lot to kind of digest here in this corn market that just largely, Mike, I'm just not getting a good – easy breezy feeling about this corn market. I know a lot of producers are kind of the same way right now.
Yeah, I think you hit it right on the nose. That's the best way to say it, is that it is not a market that you really feel like can come back around right now because of the supply that USDA put on top of us, not just the stocks report being near 5 billion bushels, but that big increase in acres led by not just my state of Kansas, but also almost 5 million more acres for Minnesota and Iowa in corn plantings versus the March expectation. I'm calling that into question. I'm in contact with USDA to find out more about that specifically, but taking that off the table, I really think this is a market where we don't want to put our egos on the line. And I say that especially for me, because I still see a corn price in Paris futures $1.75 over the mercantile price of around $4, Jesse. And we've got a 445 Gulf price now, and that's what this purple line is showing you. NOLA New Orleans corn delivered 445. We've lost 50 cents a bushel plus in just the last 3 weeks, if not 5 weeks. And I think this goes back to the idea that why is the Paris corn premium $1.75 a bushel versus the United States? Is it about the U.S. crop size versus the world crop size? And the funds can't connect the dots because we see that, as I said about Ukraine's drought, we also have China reportedly buying corn from Argentina. Yes, part of it's political, but the other part is Chinese weather, and that was reported by Bloomberg a couple times this week. The other thing that I keep looking at is where the Brazilian corn price is. It's running at least $5 a ton underneath us, or Argentina is running about $5 a ton underneath us. Brazil's almost $10 a ton underneath this Gulf price. So there's a lot to be said about unanswered questions in the corn with this premium in Europe versus the United States and how cheap we've gotten. And I think part of this goes back to what happened back in 2013, 2014. We went up in early 2014 after coming off that major move up from the drought of 2012. And then we made all new all-time lows for that decade in 2014. And we just went into the gutter for the next 5 years on deflationary pressures led by China and Europe. So I've told clients very plainly, I'm not going to let my ego stand in the way here. If we take out that 390 and a half low from the report day last week, the June low for lead month corn, I want to get some protection in place for both old crop and new crop, because I just don't want to see the type of slide be replicated that we saw in mid 2014.
I want to throw another wrinkle in here and just ask you, since we're looking at this chart and you got the NOLA price up there. We got Hurricane Beryl out in the Gulf here in the Caribbean, and I believe they said it was the first Category 5 storm this early ever in a hurricane season. I mean, any major impacts you foresee in terms of maybe exports or more from the U.S. Gulf with this storm track potentially, Mike?
Yeah, I think this is a really big key as we come back from the holiday trade on Friday through Sunday night, because I've been tracking what this is called the spaghetti model, all the different models and their expectations for where Beryl will go after it crosses the Yucatan. And you can tell the range gets real wide after it crosses the Yucatan Peninsula, but there are a lot more models dragging it into up the Mississippi River and into the Ohio River Valley. And I think with the saturated soils that we're dealing with in almost all the Corn Belt now, and I know there's still some dry areas out there, don't get me wrong, I know there's some producers really wanting some rains right now, but I would say over the last 30 days, the trade's gotten too comfortable with the amount of water that we've put down, Jesse, whether it's Minnesota, Iowa, whether it's here in Northeast Kansas, Northwest Missouri, or whether it's down in Southern Illinois now, which is starting to get really pounded. And this hurricane, I think, could really be a situation where it could change the direction of the market in terms of not being actually price negative and bearish, but actually maybe being price friendly and bullish because of what it could do to the crop supply, the crop production. And I honestly think that's why the beans had such a nice day on Wednesday. It wasn't just the unknown export sales that we saw come across the wires. I really do think they're starting to wake up to the idea that we could be losing production in the upper Midwest already. And why I say that is because I couldn't believe my ears when I heard other traders and analysts saying that, well, the Minnesota and Iowa guys will go ahead and replant after this rainstorm. It's like, are you kidding me? 15 to 20 inches of rain. They've lost all their nutrients. They're not going to be in the field 3 to 4 weeks. So I think the trade's finally getting woken up, led by the beans, that we're going to see a situation potentially we could really hurt this bean crop and add a lot of disease and a lot of flooding pressures. And I think this is the short-term fix to not needing to go through the report day lows. We don't have the wheat on our side, which I'd love to have that back on our side like we did on Monday. But Beryl could be an answer to some short covering reasoning after we come back from the holiday.
We are talking with Mike Zuzolo from Global Commodity Analytics here today on the show. And to that point, real quick, Mike, that we're talking about Beryl here and all the rain, et cetera, et cetera. It's felt like that for a while here, the theme of, rain makes grain no matter what has kind of permeated through these corn and soybean markets. But to your point here about soy, it's an interesting caveat that more folks are worried about soybeans versus, say, corn in some of those high production areas. And talk about that thought a little bit here in the trade, this whole, rain makes grain no matter what kind of situation.
Yeah, this is an interesting dynamic because I think part of it is just oversimplification of the plant height. It's like the old saying, you can't drown wheat because it's a weed. Well, I think beans, that the old saying is they hate wet feet and they're shorter. And they're very short in some areas. And I witnessed that myself when I went to St. Louis this past weekend. I could not believe the shortness of the corn and bean crop in 1 out of every 5 or 6 fields. And that lasted all the way to central Missouri, Jesse. I think the other thing is what USDA did on the acreage report. Not that they took the bean acres down. They only took the harvested acres down, I think, 300,000 acres. It only is going to take our carryover down if you ran it through the supply demand fundamentals. I think around 13 or 17 million bushels. We're still going to have over a 400 million bushel carryover in soybeans, in other words. But what they did do that really surprised me, and this is what I'm trying to follow up with them on, is planted acres not yet planted, and producers saying by mid-June even they had not gotten almost 13 million acres of soybeans not in. That compared to about 8.2, I think it was last year at this same time. So does that mean, can you say there's 4 million acres out there that didn't get planted and won't get planted if Hurricane Beryl comes barreling in and really changes the dynamic? And I think that's what's on the table with some of these traders and these funds at this point, if I had to guess.
Let's talk a little bit more about soybeans. I'll pull up the annual soybean continuation chart you shared with me. And as we saw again, a good start to the month here in beans and bean oil. Your thoughts as we look at this soy complex a little more in depth, Mike?
Yeah, the thing I want to talk about here with the annual soybean chart we're looking at, because this is the annual move, and boy, you look at the far left, just as a side note, look at that 1973 market going from roughly $4 to almost $13 in 1 year. Even that far back, it still stands out as a crazy year. But what I see in this market right now, Jesse, is if we still have a 400 million bushel carryover after the tropical weather season's over with, and we come out with the next WASDE report from USDA on the 12th of July, I think that could be very supportive for the corn because of that world corn supply versus U.S. corn supply. But what's it going to do for the soybeans? Are we still going to be relatively ample, if not at 10, 15-year highs for world soybean stocks and stocks to use ratios? And so this chart suggests to me pretty strongly, with that in mind, you just don't want to touch those old lows at all around that 1120, 1125 area in the front end beans. And I think the actual low, like the June low, was around 1146 and a quarter last week. So we didn't retest that. But that moving average and that low year to date on the soybean chart here speaks to me that that is your Custer line. That's where you cannot let anything go as far as support, or you need to get moving, because next stop really is that 840, 940, 1040 channel that we tend to try to trade in many years, for sometimes the whole year.
I want to rope in some outside market macro fundamentals and thoughts here as well, tied with grains. I noticed a pop in gold on the day Wednesday. Talk about what you were seeing there, Mike.
Yeah, this is a cutout of a headline that came out, and I've been watching for this ever since the debate last week. With record high U.S. equities markets and the dollar moving up towards right up against its 3-month high in the last couple weeks again. I really wondered after the debate, why would you be long U.S. assets, especially given the U.S.-China trade frictions, the two largest economies in the world, having to go at it with one another between now and November. And then you throw on top of that the idea that Fed rate cuts and Fed rate cut bets, like this article talks about, is predicated on the idea that the Fed not only thinks that they've gotten and conquered inflation, but probably means that we're heading towards a recession. So I'm sitting here thinking, okay, why is it risk on for the equities and the dollar, but not risk on for the commodity sector? And I think what really is coming around now is that the trade is looking at copper, at the gold, at the crude oil market. It turned around and went sharply higher on Wednesday's close as well. And so we've got the dollar hitting a 2-week low. We've got jobs data and PMI services, factory data all coming in really a lot weaker than expected here in the United States. And I think it could breed a mindset once again, like we saw at the end of April, early May, of a change in direction of these commodities to more of a risk on, with emerging markets being bought instead of the U.S. being bought. And I think that's something to really watch for, probably starting next week, if I would have to guess, Jesse.
One of the favorite charts that you share with us that I love to look at with you as well as we wrap up our look at charts here today on the show, wheat and copper. And you mentioned copper there a little bit. I mean, what are some of the indicators you're watching here between these two markets that I think most people would go, why are you comparing wheat and copper? But I know you've found some interesting correlations here, Mike.
Yeah, I mean, that 10-week correlation is still stuck at about 0.65, which means a 65% positive relationship in the lead month futures between copper and soft red wheat on a 10-week running basis. It really has not gone negative ever since the beginning of 2024. So that would be point number one. They're still very tied to one another. They're still very tied to one another in terms of the demand side of the market and the economy, especially when it comes to China. And I think this is where we do have to parse out the trade frictions with the grains, and that agriculture, unfortunately, is on the front lines, the battle front lines, when trade gets worse between two nations, especially the biggest commodity buyer in the world. But I like the turn in the copper, and I think it gives the wheat the upside potential if and only if the dollar breaks lower. And so the question really is do we go into the second half of the calendar year heading into the election now with a weaker dollar? I can make a stronger fundamental case for that than I ever have been able to before, Jesse, given what we've dealt with here the last several months.
Want to talk livestock as well before we run out of time here for analysis today. Cattle continuing to surge their way higher, led by feeders, Mike. I mean, you look at that cattle complex. What stands out to you of note here as we work through the 4th of July time period?
We needed the feeders to come around, so it's extra nice to see the feeders turn this market higher and essentially allow the fat cattle to play the higher market, because we still have that negotiated cash price in fat cattle at above 195. At least that's the last place we stood. And that's a $10 premium to the August futures. So that was there before the feeder market turned around, but the cattle had a hard time doing anything with that. Now all of a sudden we've got those choice box beef cutout values back to 330 plus. And we also saw a really strong featuring mindset by the retailers for the July 4th holiday. We've got the burger wars coming back as well. That was in the news here this past week or so. The McDonald's, the Burger Kings, Hardee's fighting and beating each other over the head to try and gain back market share by having lower burger prices. So the cattle and the beef side really heading into July 4th, running essentially on all eights. They even have the hogs at least not dragging them down. At least the hogs are stable and not super low. They haven't come up much, but they aren't going down either. So it's a nice way to go into the July 4th holiday. I think I would still stick with the game plan, though. If we can get back up towards that 195.60 area, 195.65 in lead month cattle, that 264, 265 high that we made in the feeder cattle and lead month futures not too long ago, those I think are still places where you want to turn back into being ready to hedge these markets. But I want to let it run if it wants to run here, with one eye on the dollar, one eye on the stock market.
Real quick, do we have to keep an eye on headline risk though too here in these proteins and in the cattle especially? I know you mentioned to me before we went on the air, headline, more bird flu worries in Colorado now with a human case. I mean, has the market kind of become desensitized to the bird flu news, Mike? Your thoughts on that?
I hope they are. I think that the Moderna approval for the HPAI vaccination for animals, I'm hoping that works into the market on Friday. I think Friday's going to be an interesting day because we do have this Colorado man reportedly having it, working at a dairy, has mild symptoms. But I think the general rule of thumb for me, Jesse, is I worry more about headline news if the funds are on the other side of the market. So depending on how long they are right now, does that spook them and take us down in a sharp corrective wave or not? And they have been building back up their net long position these past couple weeks.
All right. Final thoughts for us here today, Mike, as we wrap up our conversation. Anything you want folks to keep in mind?
I would just go back to our opening comments, and that salvo is, what is the world corn price versus the U.S. corn price? And how much does that Black Sea drought matter? And I think we're going to find that out here in the next couple weeks. But I'm not going to let the ego get in the way. If we take out lows, I'm going to get protected, especially in those soybeans. I'm looking for a lot out of the WASDE report, though, when it comes to the corn, Jesse, and to a lesser degree the wheat, because we did see a lower acreage base in that wheat complex from that report as well.
Mike, if folks want to reach out to you, take a look at your analysis and get in touch much more, I know they could do that easily online. How can they reach you?
Yeah, best place to go is globalcomresearch.com. Globalcom with 2M's, research.com. Sign up for a 2-week free trial. That gets you all the way into the later part of July. Get a lot of research, and then also take a look at our product services.
Well, with that, Mike Zuzolo, Global Commodity Analytics. Have a happy 4th of July, sir. Thanks for joining us. We'll talk to you next week.
Thanks, Jesse. Happy Independence Day to all the listeners and viewers out there as well, and especially you, buddy.
I appreciate it very much. Mike Zuzolo joining us today on Market Talk. No markets Thursday. Hard open, 8:30 a.m. Central on Friday. Thanks for listening. I'm Jesse Allen. Have a great rest of your day.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.